Hi, everyone. This is Tim Melvin with the Tim Melvin Deep Value Letter, back once again after a week of vacation down in the Everglades and the Keys, spending some time with the family. We're back with a value investor's look at the world and at markets. Markets were basically flat this week. Looked originally like we might have a nice strong up week, but it faded as the week came to a close. Amazon and some of the other tech leaders' earnings didn't really hold up to what people had expected, particularly Amazon, as people are starting to figure out you can have all the sales growth in the world. Sooner or later, you got to start turning that into bottom line profits. It's not happening there. We saw some people jumping ship on the stock in the late in the week this week, and that helped lead the market to what's basically a flat finish on the week. I was talking to a couple buddies that are traders, take more short-term positions than I do, and pretty much universally, their attitude was they were taking nothing home over the weekend because they still remain very concerned about the situation in the Ukraine. If shooting starts over there and we've got Russian and soldiers from the West involved in that thing, we're going to get into a real messy situation real quick. We're blistering and blithering about sanctions, but the truth of the matter is, I don't think Mr. Putin cares about sanctions. He's perfectly willing to endure whatever he has to. And he's not afraid to shut off the gas to Western Europe either, which is going to cause some problems for the European markets with spillover into the U.S. economy and markets if that should happen. We can't predict it, so we'll just wait, watch, and see what happens as always. Anyway, looking out at what's going on in the world, markets are still kind of where they were. They're basically pretty overvalued at this point in time, I think. And we're on the high side of fair just as we have been. So there's no point going back and beating a dead horse. Where we are watching very closely, I just got done going through the private equity reports and buyout fund reports for the first quarter of the year. And the money's still kind of, there's a lot of cash out there. There's more piling up every day because exits are at a record level. IPOs are going to be, set another record for PE backed initial public offerings if we keep going in this vein. If the markets stay relatively strong next few months, you're going to see a lot more deals come to market. So, but the money is flowing into some areas that we have an interest. We like to follow behind the private equity money into out of favor sectors. And right now, that money is going into mining stocks, and we have significant mining positions in the portfolios. We like the mining business long term. I know nothing about gold, silver, or any of that stuff, how it trades, why it trades. But the business of mining gold and silver right now is very cheap. We're paying 50 to 60% of tangible book value for some of these companies that have rock solid balance sheets and should be able to survive long enough to thrive. At some point, we get a big rally in precious metals over the next 4 or 5 years. I don't know when, I don't know why, just pretty sure it'll happen, and these stocks should soar. We also continue to see a high level of private equity interest in the energy industry. Not very surprising, thanks to very low natural gas prices, oversupply. A lot of the energy stocks, especially those based here in North America, are quite cheap at current levels. Again, we're paying 50, 60, 70% of book value for some of the names that we have in the portfolios. We really like the energy sector over the next decade. The same can be said of the shipping stocks. These things are at 40 and 50% of tangible book. And we're seeing private equity slowly get involved in this industry. It's taking some of the freewheeling nature, perhaps, of the shipping industry away as the suits and ties show up. But the private equity guys and the distress guys have been tiptoeing into the sector. They're buying ships, they're buying up shipping loan portfolios, buying up entire shipping companies in the case of Wilbur Ross. We like the shipping stocks. We have several of them in the portfolio that we've paid 30, 40% of book value. We've already sold one for about a 70% gain in the last year. So we're pretty big on the shipping stocks as well. We're just going to kind of tag team private equity into that area. The other thing that we still like is, just love the small banks. We've got a whole bunch of them in the banking or profits portfolio, and we've been reviewing the earnings reports as they come in this week, and we've got kind of a constant theme here, okay? Credit continues to get better, not at the breakneck speed that it was a couple of years ago, but it doesn't need to. We're seeing the incremental improvements. Everybody's getting down to that 2% or less level of non-performing assets pretty much. We're seeing pretty decent book value growth from all of our little banks in the quarter so far, which is very positive. We do still see very flat loan growth. The economy is just not generating a lot of loan demand. Credit restrictions are still pretty tight, particularly in the mortgage market on non-government backed deals. So loan growth is pretty flat, and net interest margins are still very much compressed across the banking industry. We are starting to see greater activist involvement on your reading list. You should see a copy of a study done by Harvard Law School that said, hey, we're going to see greater activism in the banking industry, particularly small banks, now that the regulatory picture is starting to take on a better shape and it is a little more clear how the Fed's going to regulate these banks, what the capital requirements will be, and that type of thing. It's probably my favorite area of the market. You know, a few months ago, I wrote a column on Real Money about the don't get killed in your sleep portfolio. And that was simply my wife was rolling over her 401k into an IRA as she left the bank she had worked for many years. And of course, I'm going to manage that portfolio. But, you know, when you managing money for somebody that's pretty much in a position to kill you in your sleep every night, you tend to be very cautious and look for the very best risk reward situations. I can tell you that that money has come in and it's almost entirely invested in small local community banks. Allows me to sleep night and I think we're going to sleep nights and I think we're going to earn a fantastic rate of return on the money. So we don't make predictions, as you know. I think that it's rather foolish to make predictions about the stock market and the economy because it's all unknowable. There's too many variables. It's just a wild guess. That doesn't stop most of Wall Street from doing it, however. And the Barron's Big Money poll is out where they ask money managers around the country what they think is going to happen in the rest of the year. So the picture is right now, everybody seems to think that U.S. equities are the place to be, going to be the best performing asset class over the next year. While they think emerging markets will be the best over the 5 years, for the short term, they like U.S. stocks with a focus on the financials, healthcare, and technology. This sounds like a repeat of every Barron's Big Money poll of the last 2 decades to this point. Um, Stunningly, most money managers in the country, I have no idea what they're basing this on, but they think we're going to get additional price earnings multiple expansion. It's expanded enough, folks. We're trading like 16 times the overly optimistic estimates, and it's 25 times the 10-year average earnings. So don't quite see how that's going to expand anymore, but I'm probably wrong, and it'll go right up like these folks think. Um, 81%, this was an interesting figure. 81% of the money managers surveyed think that the housing recovery is going to continue. Now, that's in spite of some very weak housing news over the last couple of weeks. And this time, it really can't be blamed just on the weather conditions that have taken the brunt of the blame for weaker economic reports over the last several months. We saw a 60% year over year drop in mortgage applications in this latest report. And mortgage applications right now are at a 14-year low. And that's while mortgage interest rates are still at very, very low historical levels. There's not a lot of demand. I think now that a lot of the distress buying and the heavy hedge fund and private equity buying of individual family homes has pushed the price up. We're getting a little unaffordable in a lot of areas of the country, and there's just not enough high paying jobs being generated to justify continued increases in the housing market or sustained home building activity, in my opinion. Again, I could be wrong. 81% folks think so, that the housing market is going to continue to recover, and that's what's going to drive GDP growth of 2.5% to 3% seems to be the consensus estimate. And they all think unemployment is going to be between 6 and 6.5%. Don't know how they get to that without shrinking the labor force even more, but we'll see. This is why we do not predict these things. We just prefer to react to what actually happens. The consensus of the money managers, by the way, was a 3 to 3.5% treasury yield this year and a 4 to 4.5% yield several years out. Biggest concerns right now are that earnings are not as robust as they are anticipating, and that we get some earnings shortfalls that put pressure on the market. And no shock here, they're all still worried about tapering. So taper is going to happen. We really haven't seen how the markets are going to react as we get into the second half of the ending of the stimulus programs. It's going to be fun to watch over the next 6 months is about the only thing I can say. Now, we're cranking along into baseball season right now. My Orioles are just one of the best offenses in the major league. We're number 7 in runs scored, number 4 in batting average. We're 9th in slugging in all of Major League Baseball. We're hitting at a very robust 271, 4th in the major leagues. You would think we'd be running away with things, but yeah, our pitching staff there's no margin of safety in our bullpen. I can tell you that. Pitching staff's given up about a 282 batting average. We've given up the 3rd most home runs in all of Major League Baseball, and we're 24th in ERA with a sparkling 4.46 earned run average in the bullpen so far has just been a disaster. But hey, it's only last week of April. We got a long way to go. I'm optimistic. Going to be a lot of fun baseball to watch. And I guess we have the Kansas City Royals this weekend, which will be a lot of fun to watch. Anyway, next week's a big week. We're going to confirm or deny what's going on in the housing markets. We have pending home sales, Case-Shiller construction spending. They're all out this week. We have a Fed meeting this week, so we'll see what those fellows have to say. We have the always humorous ADP number. This thing never seems to correlate with any of the jobs reports over the last several years, but everybody watches it. Everybody's going to trade off of it when the number comes out on Wednesday. And we'll see what happens. And of course, Friday, we do have the all important, almighty jobs number, and we'll see what the government wants us to think about the employment market. Particularly going to be watching the number of part-time jobs and, of course, the U6 rate, which I think is much more important than the regular unemployment rate, and the labor force participation rate. Anyway, all of that stuff has the potential to move markets. Hopefully, it'll move them down a little bit for us, create a little inventory of safe and cheap stocks for us to load up on during the week, but we shall see. Anyway, next Saturday will be the Kentucky Derby. I'm going to come out and say that I think the smart money here is going to be flocking to Wicked Strong as the week goes on. It's currently posted at 8-1. I think those odds will improve, and I think Metal Count is going to be a fun horse to use. Finished second in the Bluegrass a few weeks ago. Fun horse to use in all of your exotic bets. So I would use those to look at some exactas and other bets as we get closer to the Derby, if you're inclined towards such activities. Anyway, have a great week, folks. This is Tim Melvin of the Tim Melvin Deep Value Letter, and we'll talk to you guys next week.